All right, I want to welcome everybody to our series about talking about financial foundations. And today we're going to be talking about one of the things that, as we've seen in most businesses, they struggle with this. This is, and us included. Um, how do you predict what is going to happen in the coming year? I mean, we have bills to pay, we have payroll to make. How do we predict this? How do we know what's going to happen? So, we're going to be talking about how to leverage QuickBooks Online, how to figure out what data to look at, and we're not looking at just reporting profitability, but we want to know how much money we're going to be bringing in, what kind of revenue is coming in, and what can we do to change any of this, and how do we predict it? So it's the difference between reporting on the past of things that have happened in the past and predicting the future possibilities. So your financial numbers are not just history, they are actually some signals for the future. And so, if we look at these indicators and we can figure out what they are and what those data sources are, we can get some forecasting models and we can make changes when we see red flags that happen. So, we're going to get started. I'm your host, Elisa McCabe. I'm the owner at First Steps Financial, and we are a fractional accounting department. So we differ from other firms that do bookkeeping and controller work, and that we become part of your company. We are the accounting department at your firm. And a lot of this work is what we talk to our clients about. So that's why this was so important for me. And I was very excited um, to do this webinar to talk about what leading and lagging indicators are and how to identify them and what we can do with them. So if you give me 1 second, I'm going to share my screen and we are going to, let's see. Oh, so many interesting options now. Um, okay. So we're going to talk about predicting profit and a financial playbook. And everybody that attends the webinar is actually going to get our scorecard. It's a free scorecard that explains all these things in detail, gives you some ideas of what it might look like, and it gives you a form that you can fill out. You can fill it out online, or you could fill it out, print it up, and do it with pen and paper. But this way, it will help you. Be able to put these things that we're learning today into practice. So the financial numbers are not just about your history. Oops, wait, we pop back. It's not about history. We've always looked at the numbers. Um, it's what happened in the past. So we need to really focus on the future. We need to understand, and everybody says this when we talk about history and things like that. They say if you learn history, you can you can help prevent things from happening in the future. So know the history of your company, know the reporting that has been done in the background. It actually focuses on the confirmed outcomes, and then use those things to predict the future. So these indicators are going to tell you where you're going next. So your leading indicators, you can course correct before impact. So leading indicators, what are they? They're the metrics that forecast an outcome before it occurs. So they're going to be sales calls or traffic to your website. All these things will help you predict what is going to happen in the future. And I will get to exactly how that happens. So lagging indicators tell you what happened in the past. So they're the metrics that confirm an outcome after it has occurred. So something like revenue. When you record revenue, it's happened. It's already in the past. And your net profit is also in the past. It's definitely like you scored the points. It happened. So those are the difference between the two things. And those lagging indicators confirm that you made good decisions. So one of the things that I really love about QuickBooks Online, and it is one of my favorite reports, is that you can run a profit and loss as a percent of income. That gives you the cost effectiveness of looking at your operating expenses. So it tells you if you used the sales effectively. So it took in all the income that you made and what percentage did you spend on operating expenses? And everybody has a number of what that should be. So it helps you to say, like, all right, we're doing great. Or, oh, wait a minute, we need to tweak some of this. Sales, the same thing. Sales is, do we bring in enough sales last month or last week? Um, and it's funny because sales, when they're cash sales, are actually a leading indicator of cash flow. And the ultimate confirmation of efficiency is the net profit. So I was just in an event and they were talking about different different ways to think about cash, and cash is the reality of what happens. And so this net profit is great, but we have to make sure that the cash is coming in too, and that is also a lagging indicator. So leading indicators predict the health of future financial statements. So if you think about your sales activity, how many quotes are you putting out there? How many clients are in your pipeline? It actually is going to predict your future revenue. And that will allow you to have that. How much is future cash coming in? What are all those things that are going to happen in the future? Now, we have worked with many clients who, say they have a great sales process. I was one of them. I said, I have a great sales process. I know, but I couldn't predict how much sales were coming in. And so I had to figure out how to make that happen. So we got it down to how much outreach we do. And for everybody, this is going to be different. It depends on your business. Our business comes in through current clients. We do fabulous work with them. They tell other people, and that's how we get that's how we get new clients. So how do you do that? We reach out to our current clients and we ask them for referrals. We reach out to our current clients with satisfaction surveys to see how they're doing. So those things are predictors are if they will be referring, and then we can make that a leading predictor. Also, outreach. How many people are you talking to each month? So if you have a number, we have actually a number because we now have salespeople, 75 people they reach out to every week. How many conversations does that come down to? It's about 5 a week. How many leads does that come down to? 2. How many closed clients does that come down to? 1. And that's okay. It's predictable. And that's what you want to know from a leading indicator. Another one is marketing activity. So, you want to see how much website traffic is going to your website. So that can predict the potential pipeline growth. If all your marketing is pointing people towards your website, that's what you want to track. Because the more people that go to your website, and again, you have to have something on your website, a form to fill out, some way that you can actually get some leads generated from it. But again, these are all numbers to keep track of. Keep track of them in your CRM. We actually have a CRM called Go High Level. It is a CRM. It's social media. It tracks these first two. It tracks both of them. It tracks all of our activity on every social media platform. It tracks everything on our website visits. Every single step that anybody makes before they actually talk to us, we have both of those. And this isn't because we're superior smart, it's because we failed. because we made mistakes. We learned this is what we need to do. These leading indicators, and you don't have to pick all of them, and we don't use them all, but we use particular ones. And I will get to that about which ones you want to use. Operational efficiency. And this one is really good. And I didn't, before learning this and understanding what these leading indicators were, employee utilization rate. It can predict efficiency and burnout. And one thing you don't want to do is burn out your employees. They are your amazing resource. And there's only so much of them. And the amazing employees, you tend to use them the most. So you're like, they tend to get burnt out faster. So when you know what your employee utilization rate is, you know how well they're working, how much efficiency they're doing, and if they're working too much. And those two things will help you to either hire, because you might need more people, or it will help you to create efficiencies. So the key insight from this is a dip in quote volume today will guarantee a dip in revenue tomorrow. So if you're sending out 10 proposals and that's one of your numbers, that's one of your leading numbers, and you know that 10% are going to say yes, or 20%, or whatever your percentage of people who say yes to proposals are, and we all know this number. You have it inside. You can look last month, how many proposals did I put out? How many said yes? That's your percentage. So, and then from that, you can predict if I put out over time, again, it's an average. One month you might have 5 people say yes out of the 10 you sent out, and another month you might have 1. So take the average over the last 3 months, and that will help you to know what you can expect for your revenue. So you need to bridge this gap. So it's external data and it's non-financial data and your internal information. So the external stuff, we don't have a lot of insight to. Well, we do have insight. We don't have a lot of control over the external information. So right now, the world is a little crazy. We have things going on, economic upset. Those things we don't have control over. Sometimes there's marketing trends that we can't control and those things, but knowing about them helps with the other 2 things that we do know about. Our non-financial things, the CRM, project management, time tracking, those things, knowing that information, and then using our internal data from QuickBooks Online. Most people use QuickBooks Online and have some information, and then you tie these 2 together so that you have your leading indicators and making sure that the outcomes happen in your financials. So this is also, I wanted to make sure that we did touch on this. One of the things you can do to really narrow down the information is to use classes in QBO. It can help you to develop what part of your business is becoming more profitable or not profitable. And that helps you to make decisions. Also, having a budget will help you start to think about the future because you have to create the budget for the year for a period of time. And it will help you thinking about what happens and then using the budget versus actuals. We'll see if you're on target. They're just tools that you already have. They're all inside of QuickBooks that will help you find out how things are going in your company. And many times they will help you to make decisions. So focus on the vital few, not the trivial many. So what you want to do is pick 3 to 5 metrics that are specific to your business model, and do not overcomplicate it because you can get really crazy in it. It's easy to get sidetracked in this and really dig into this. Start with something. Pick anything. The rule of thumb is pick a liquidity metric, a profitability metric, and then 1 to 2 growth activity metrics. If that doesn't work for you, if that you can't easily do one of those. Pick just one that you can. Don't get sidetracked because it looks difficult and hard. Do something like, how many leads came in this month? How many people did I talk to? So it's definitely something that you want to be able to take that number and track it somewhere. Figure out a great number when you run in QuickBooks, and this number everybody has. If you run a profit and loss by income, you can see how much money you spent on your labor and your cost of goods, and what percentage of that is going to your sales. That number, if you're in a service-based business, is predictive of how much your profit is going to be. So if you reduce that number, if you reduce your payroll, reduce cost of goods, it is going to increase your profit. So it's something that helps you look at it and figure out, is it too high? Is it not proportionally correct? So that is one of the metrics that are easy to do, and you can do it. So historical trends are going to predict. So what you really need to do is do a trend analysis. Go back and look at what happened. And a perfect example is if you had growth rates and quarter 1 was always 10%, it's probably what it's going to be 10% this quarter too. So when you go back, it is crazy how much you can see what has happened in the past that's going to help you predict the future of what is going to happen in your company. Now, there's always things you can do to change it, but it's a good place to start. So go back, look at your trends, look at historically what your revenue growth was, quarter 1, quarter 2, quarter 3, quarter 4. What was it over time? What happened in different periods? What were your expenses in those periods? What percentage was that? And then you can start to apply those going forward. It's easy information to get inside of your QuickBooks. So when you understand time delays, it unlocks your accurate forecasting. So we're going to talk about a little bit about forecasting, about predicting the future, about when are you actually going to get this revenue, and how do you know when it's coming? So if you figure out how many leads you get and what's your conversion rate. So you sent out 10 proposals. I have a 50% conversion rate. That's going to be your predicted sales. But how long do those people take to pay? Is it 10 days? Is it immediate? Is it 90 days? What that is the key of, you can predict revenue months in advance if you know what your sales cycle length is. So this sales cycle is exactly where the problem can lie. And then you can actually start to predict your cash flow, which is so important. Cash is the lifeblood of your business. And that's when you can start fixing these things. I was actually in an event this morning, and someone said they have a cash flow problem because of this exact issue. They know exactly what their conversion rate is. They know what their predicted sales are, but the people, and it's a large client, is not paying on time. And it is causing so many issues in their firm. So figuring that out can change everything. Of course, anyone that knows me knows that I tell everybody's on automatic payment. It's the way it goes. It's predictive for both sides of it. So your client knows when they're going to pay, because it's going to be withdrawn from their bank account or charged from their credit card, and you know when that money's coming in. So this allows you to do some scenario planning, and I hope you guys can hear the dog barking in the background. So there's 3 scenarios that you want to look at. You want to look at, like, what is the best case scenario? What's the highest conversion, shortest cycles, like the best of the best? What can happen? Now, what if it's just like based on current averages? What about that? What does that look like? And then worst case scenario. And we used to have a cash flow forecasting program that I loved because it said if you did not make one more sale, where would you be in 3 months, 6 months? What would it be? So start looking at things like this because this will help you to know what your key predictive indicators are. So if something happens, so it's recognizing these different things that are going to happen in your business or that can happen. So if one of the things you're looking at is your pipeline is drying up or there's like a high customer churn, okay, that's going to mean future revenue gap. And then we have to figure out, how do we fix this? What about if the gross profit margin is declining despite steady revenue? That means that rising costs are eating away at your efficiency. One of the things that we forget is that everything increases. So our payroll increases because we give raises every year. Our health insurance raises, and not just by 5%, it goes up 30%. All these things increase, and you have to keep these in mind when you're thinking along these lines. And then your cash, your accounts receivable days are increasing, and this cash crunch is going to happen. We have someone that we work with, and when their when their accounts receivables goes past 30 days, we instantly know exactly how much their cash crunch is going to be, and they're ready for it because they work with larger companies, and larger companies don't pay on time because they know if you're a smaller company, they can mess around with you. But we know this ahead of time, and that makes it better to deal with. So you need to have like a rapid response to this. So sales and marketing. So you have a revenue dropped. There are things you can do. So all of a sudden your pipeline is like, what's going on? It's starting to dry up and you're trying to figure out, how do I fix this? Do a short-term promotion. Follow up with old leads. And if you have a sales team, review the sales training materials. Like maybe something's happening. Maybe they're not communicating the value that you provide efficiently enough so that that pipeline is filling up. What about if you have a margin squeeze, things are costing more? Start looking at supplier costs, and we do this all the time for our clients. When there is a situation that happens that they know that they're gonna have a cash crunch, and we're like, okay, how can we cut costs? Well, there are things you can do. One of them is renegotiate supplier costs, implement a temporary freeze on non-essential spending, and then increase your prices. And this is something that a lot of people forget to do. Um, and we say strategically because you want to increase with new clients coming on, not your older clients, because that's a lot, and do it gradually. And you should be doing a price increase every year. Are your costs going up every day, every year? Are you becoming more experienced every year? Those are the things that will actually prevent you from having this problem. So you need a rapid response. So in any of these situations, when you have that leading indicator that says, uh-oh, people are going past the AR, days are increasing, what are you going to do? You know you're going to have a cash flow issue. So tighten up AR collections immediately. Fastest way to get people to pay, give them a call. We actually have a 3-step process that tightens up that AR and has a very high rate of success because nobody wants to be bothered. Nobody wants to get the email saying, oh, you're late. Where's this money? Nobody wants to get a phone call asking for it. Believe me. And nobody wants to get a letter saying, we're going to have to consult with our collections attorney. People don't want that, but that's the things you have to do. You can also offer that if they pay early, you're going to give them a discount. And then utilize short-term lines of credit. This is only if the pipeline is confirmed. So you don't want to be using your lines of credit to pay bills when there's no money coming in. That's just going to put you in debt. So making these strategic adjustments is going to help you to create sustainable profit. So in your product mix, you're going to want to get rid of low margin offerings, and you're going to focus on the high yield services. Now, previously, I was telling you about setting up your QuickBooks and using classes. So do you know what your high yield services are? Do you know what's making you the most money? Do you know what program is making you this money? What service what project you worked on that made the most money? We have a client who works mostly with residential. They had a job with an industrial, they had an industrial job. They made more money on the industrial job than they do on the residential. They know that because we tracked all that information in its own project, put every cost against it. So now you know what? They're going after industrial jobs because they know that will make them the most money. And they did it one time, they can replicate it. So start to figure out what that is. Automate processes. Oh, this is anybody who's talked to me before. I'm the queen of automating processes. I want everything to be automated. I don't want humans to touch things because if it was me, I'm definitely going to make an error in it. But that's why I want a machine to do it. And I can actually look at it afterwards, make sure it is correct, and go through and lower your cost of goods and your operating expenses. There is actually an app that will go through and look at how many subscriptions you have that you're not even using, that you're paying for. Do the same thing in your business. There are subscriptions that you're paying for that you're not using. I guarantee if you went down and did a deep dive and looked at your expenses, you would be able to reduce some of those things. And then pricing. Shift to value-based pricing. I'm a huge proponent of this because what you bring to your clients is so valuable, and you have to be able to communicate that value to the client so that they understand what it is and they will be willing to pay. Because if you're starting to fight on price with somebody, saying, well, I have to charge this because that's what everybody else does, you're a commodity. You have no unique ability except for you're comparing your price with others. So this is a predictive cycle. It's like you have information. The source of your data is all your leading indicators. And then you have those lagging indicators to make sure that things happened. And then we have our forecast model so that the things that we hoped were going to happen, did they happen? And then the actions that you can take, and then the corrective responses. So you can look at things and see when they're going to happen. It's your crystal ball to be able to look at your leads to make sure that you have enough, or that those leads, that pipeline is turning into revenue. And if it's not, then you know you're going to have a cash shortfall. So the first thing that you can do is identify one leading indicator that is relevant for your business and establish an action threshold for it. For example, one leading indicator that you could use is how many discovery calls you had this week. So put an action number to it. Say, okay, it's going to be 2. I want to have 2 discovery calls with clients every week. Well, then you start working backwards from there. How many people do you have to talk to get those 2 people having a discovery call? Do you have to start with 75? Do you have to start with 100? where do you start? But if you can establish that one number, if you can put that line in the sand, you can move back and decide how to get there. And then the actions you can go going forward from it. Because you know, if you're not getting those two that you want, the issue starts behind you. It starts at those at any of those leading indicators, whether it's outreach or anything that's going to bring in those sales. It might be ads on Facebook. It might be Google ads. Those might be the places where it starts and lands you those two discovery calls that will land you that one client. So start somewhere. Don't get overwhelmed. I know it's easy to get overwhelmed. I totally understand that. We're business owners and we have so many things going on in our lives. And it's easy to get distracted and take our eye off of the prize of running our business really efficiently. Stop sharing right now. There we go. If you have any questions, you can put them in the chat. Someone had sent me a question even beforehand. They were asking me, okay. Someone said, you mentioned moving from reactive bookkeeping to proactive financial forecasting. What's the very first step an entrepreneur should take tomorrow morning to start making the shift? You have to know that you're empowered to do this. You can do this. I can't tell you how many people say, like, well, no, my industry is very unique. It's actually not. I'm sorry to break it to you. But there are, if you sit down and you think about it, there are things that predict what's going to happen. You just have to have the mindset to know you can do this. It is within your control to do this. And I think that would be the first step I would want you to take tomorrow when you wake up and say, I know that I can predict how much money is going to come into this company. And when you start thinking like that, it starts putting you on a different mindset and a different path going forward. Someone was asking about most common mistakes entrepreneurs make in their QuickBooks Online setup that prevent them from easily extracting the essential reports. So there's a rule, and it's probably a rule for everybody, scientists, engineers, garbage in, garbage out. If the information you're putting in isn't accurate, isn't put in a way that makes sense to you, you're only going to get garbage out of it. Make sure the information going in, are you tracking the different types of sales you provide, the different services you provide in categories, and then applying expenses to them? That's going to tell you, that's going to give you a lot of information. It's also going to tell you how much in sales you have in that. How much are you selling of that service, of that product? And that's really helpful. And what is that the most profitable service you have? So yeah, setting up QuickBooks and making sure you're applying expenses to whatever your services are, those are really good. So red flags. So someone wants to know, what's the most effective and professional strategy for aggressive AR follow-up that you can maintain client relationships while improving cash flow? So there are a couple of things you can do, and most of them start at the beginning of the relationship with the client, and that's setting the expectation of when you're going to get paid. And then also letting them know that when you get paid, when if payment doesn't happen, what happens then? So is it going to be a late fee? You can do a late fee, and that's entirely up to you. But I can only suggest don't make it 1% because that's cheap for a loan. And that's what you're doing, is you're loaning people your money. So there's things you can do to maintain the relationship. Again, if you haven't done this work ahead of time, if you haven't spelled it out in your contract in a written format saying, this is what happens. This is how we're going to get paid. This is what happens when we don't get paid. This is how we're going to break up. If you haven't done those things, one of the things you can do, and I just had a great discussion with someone about this. You have to have the conversation around that, look, our payment terms aren't working for us. And I imagine they're not working for you. And we want to continue this relationship. How can we come to a conclusion that we're both happy with? So those kinds of conversations will help maintain the client friendship and still improve your cash flow, because the bottom line is you want to get paid. And there are just some businesses that you really don't want to work with. And that's a hard truth to come by. Uh, Someone asked about strategic pricing. They said, when is the right time to stop trying to lower cost of goods sold and instead focus entirely on moving to value-based pricing to solve the margin issue? If you feel, and you'll know when you feel it, you've gone through your cost of goods sold, you've gone through your general expenses, your insurance, your subscriptions, like all those things. You've gone through everything, and you really feel that everything you're paying for is providing value to the firm. And I mean real value, not just, oh, well, we use it sometimes. No, that's not good enough. And it's not a nice to have, it's a have to have. When you have gotten to that point, that's when you can start focusing on, okay, how do we move to value pricing? And again, I highly suggest you get a marketing specialist, a brand specialist to have that conversation about explaining what your value is. And some people are just never going to get it. So don't worry about it. You are not for everybody. Just be okay with that. Um, you're going to give your pricing based on the value that you provide. And the value that you provide, either they get it or they don't. I tried to explain to a potential client one time that the value that we provide, we actually can increase your sales. And they said, no, you can't, not unless you're out there selling our product for us. And what they didn't grasp is that when your clients get their invoices on time and they're correct, they think that you have your act together. And whatever service you provide, you must be really good at it because this part of your company is running really well. And it increases the value that people put on you as a company. And some people just aren't going to get that, and that's okay. So you have to figure out what your value proposition is and be able to explain it and also be okay with them not understanding it. And it actually is like a flywheel. Once you get that value-based pricing going, it continues and it takes on a life of its own. And more people will be attracted to you because of that. But again, it all starts with these leading indicators. I'm very excited to send everybody the template. You're going to get it. We're going to send out a follow-up email tomorrow. And it is, I'm actually going to share it with you right now so you can see it. Hold on one second. So this is what it looks like. It's 12, it just goes into like, these are the proven metrics for growing companies. It has leading indicators and lagging indicators. It gives you examples of both. It talks about, this is an example of what it would look like. And then it also goes into like, what would some of these be? Like sales calls booked this week, different things, just to give you ideas. This is supposed to spark you. It is not, I'm not telling you exactly what to do because I don't know your company, but this will give you ideas of how to think about this. And then it goes down to here, you can pick what metric it is, what type it is, who owns it. And up here I have a template, which who owns it? What's the target? What's the actual? Is it on track or not? And these are things our company runs on EOS, which is something developed by Gina Wickman in a book called Traction. And This is one of the things. We own it. We check it every week. If it's not right, if it's off track, there are actions that we take to fix it. So number of new leads this week, we know if it's off, if it is off track, we actually will step up doing outreach because we know that is the trigger to the new leads. So all these things have leading and lagging indicators, and those are the things that you want to put on your scorecard. And these are just examples and who owns them. And everybody's going to get this. And if you have any questions about it, I love talking about this, as you have already seen. So please just reach out to me. I'm more than happy to do that. And if you want to go through and fill out the scorecard, it's a template. More than happy to work with anyone on that. So I hope everybody enjoyed this. I hope it gave you lots of information. I hope you understand leading and lagging indicators. They can be confusing. The first time they were introduced to me, I didn't really understand it. And so I had to dig in and figure it out myself. Because in EOS, they actually won't give you a scorecard example. Sorry, I did it. You can go tattle on me. But I felt like I needed something. I can't work on a blank canvas. So I figured other people probably feel this way too. So take a look at it. If you have any questions, I'm more than happy to talk with you. And I hope everybody has a great rest of the week. Take care, everybody. Thanks for coming.